Imagine waking up one day and realizing that the world's financial backbone, the greenback, is no longer its unchallenged spine. What if the currency you thought was invincible started slipping, not over decades, but rather in months? Top economists are now warning us the dominance of the US dollar could end very fast. And if you think that impacts only Wall Street or governments, think again. It could affect every business, every investor, every family here and across the globe. The world's financial system has been built on a single foundation for decades, trust in the US dollar, but trust isn't permanent, it isn't unconditional, and it isn't immune to reality. Right now, the vulnerabilities inside the US economy are growing so large that confidence in the dollar's role as the world's anchor is starting to crack. And history tells us that when cracks appear, they don't stay small for long. They widen, they accelerate, and they bring down structures that once seemed unshakable. At the heart of this problem is debt. The US government owes more than it has ever owed before, and the pace of borrowing isn't slowing, it's accelerating. Trillions in debt are being rolled over into higher interest rates, meaning America is now paying record amounts just to cover the interest, not the principal. Think about that for a second. The strongest economy in the world is in a position where an ever-growing share of its budget goes simply to servicing what it already owes. That's not productive investment, that's financial quicksand. And every investor, every central bank, every trading partner watching can see exactly what's happening. Then there's the deficit. Year after year, spending far exceeds revenues, and instead, of course, correction, the gap keeps widening. You cannot run a business like that and expect investors to keep trusting you forever. At some point, creditors start asking tougher questions. They demand higher returns, or they move their capital elsewhere. Nations are no different. If Washington can't balance its books, why should the world keep parking its reserves in dollars? Add inflation to the mix, and the picture gets worse. For years, the dollar's dominance was protected by a simple promise: stability. A dollar would hold its value, inflation would stay low, and your reserves would be safe. But recent years have shaken that belief. Inflation has spiked, and while it has cooled somewhat, the scars remain. When prices rise too fast, confidence erodes. Because holding dollars isn't about the number in your account. It's about the purchasing power it represents. Lose that, and the entire premise of dollar safety begins to collapse. These vulnerabilities don't exist in isolation. They are compounded by politics, political brinkmanship over raising the debt ceiling, threats of government shutdowns, endless gridlock. These are signals the world does not ignore. Investors hate uncertainty, and the US has been sending more and more of it. If the world's largest economy can't guarantee continuity of its own government funding without drama every year, why should the world believe its currency is untouchable? Stability is a perception game, and perception is shifting. The danger here is not just gradual erosion, it's acceleration. Confidence works like gravity. It pulls everything toward it when it's strong, and when it weakens, the pull reverses. It pushes capital, reserves, and trust away. Look at history. The British pound once held the position the dollar holds today. It was the global reserve, the backbone of trade, the safe asset of choice. But as Britain's debts mounted, as its empire shrank, as wars drained its finances, confidence slipped. And once the slip started, the fall was much faster than anyone anticipated. The US is on a similar path: growing debt, rising interest costs, political dysfunction, inflationary pressures. Each of these on their own would be manageable. Together, they form a storm. The world is not blind to this. Central banks from Asia to the Middle East are already diversifying their reserves. Countries are signing agreements to trade in their own currencies. Gold purchases by central banks have hit levels not seen in decades. These are not isolated moves, they are signals of declining trust. And here's the hard truth: once confidence goes, it rarely comes back the same way. You don't rebuild the idea of permanence. You don't easily convince the world to just trust us again. That's why the vulnerabilities mounting inside the U.S. economy are not simply domestic problems, they're global warning signs. Every dollar printed, every deficit run, every political crisis broadcast across the world chips away at the belief that the U.S. can always deliver on its promises. For years, America's strength has been the privilege of issuing the world's reserve currency. That privilege allowed it to borrow cheaply, to finance deficits without punishment, to project power globally at a scale no rival could match. But privileges are earned, and they are maintained by trust. Debt without discipline erodes that trust. Inflation without control erodes that trust. Politics without responsibility erodes that trust. And when trust is gone, privilege is gone. The real danger is not that the dollar disappears overnight. The danger is that the vulnerabilities already in play create a tipping point moment. Investors, governments, and institutions will tolerate weakness for a time, until one day they don't. And when that moment comes, it won't be a slow fade. It will be a rush for the exit. Capital will move, reserves will shift, and the world's financial map will redraw itself in real time. That's why this isn't just about economics. It's about foresight. It's about recognizing that the strongest systems collapse not because they are attacked from outside, but because they corrode from within. The U.S. dollar doesn't have to be toppled by a rival currency to lose dominance. It simply has to lose the one thing it has always relied on more than anything else: unwavering confidence. And right now, that confidence is being tested more severely than at any point in living memory. The question is not whether vulnerabilities exist. The question is whether leaders will confront them before they trigger the shift, or whether they will deny them until the world decides for itself. And by the time the world decides, it will already be too late. For decades, the world has operated on one assumption: the U.S. dollar is the glue that holds global trade and finance together. But beneath the surface, that assumption is being tested like never before. A quiet, deliberate, and increasingly coordinated push is underway to reduce reliance on the dollar. Call it de-dollarization, call it diversification, call it survival. Whatever the name, the trend is real, and it's gaining momentum faster than most realize. The spark came from pressure. When the dollar is used not just as a currency, but as a weapon, countries start thinking differently. Sanctions, asset freezes, restrictions on financial access, these tools may be effective in the short term, but they send a clear message: your reserves, your trade, your financial freedom are never entirely safe if they depend on the dollar. For nations watching reserves vanish or transactions blocked, the lesson is simple: build an alternative, because relying solely on the dollar means giving someone else a veto over your future. That's why we're seeing countries cut bilateral trade deals in their own currencies. India and Russia settling oil payments in rupees, China and Brazil bypassing the dollar in their trade, Middle Eastern nations exploring pricing energy in currencies other than USD. These aren't symbolic moves, they're practical steps that shift demand away from the dollar brick by brick. Once enough bricks are removed, the foundation starts to look less secure. Central banks are responding too. They're not just holding fewer dollars in reserves, they're buying gold at record levels. Gold doesn't require permission, doesn't get frozen, and doesn't lose value when political winds shift. It's an insurance policy against overexposure to a system many now view as risky. And this trend is broad, not confined to one region or one alliance. From Asia to Latin America to the Middle East, the logic is the same: Too much reliance on a single currency is dangerous. Technology is adding fuel to this movement. The rise of central bank digital currencies is not just about modernization. It's about creating direct, controllable systems that bypass the dollar-dominated channels like SWIFT. China's digital yuan isn't just an experiment. It's a strategic bet on reshaping global payment. If cross-border digital settlement systems scale, they remove one of the dollar's most entrenched advantages, its role as the middleman in international transactions. The less the world needs that middleman, the less indispensable the dollar becomes. This shift is not theoretical, it's already visible in the data. The dollar's share of global reserves has fallen from over 70% in the late 1990s to under 60% today, and the trend is downward. That's still a dominant position, but the trajectory matters more than the snapshot, because when confidence shifts, changes that once seemed impossible can accelerate overnight. The British pound once held the same untouchable status. Until it didn't. The real driver behind all of this is not hatred of the dollar, it's self-preservation. Nations are asking, why put ourselves in a position where someone else controls our economic lifeline? Why allow a single country's political decisions, deficits, and inflation to dictate our financial stability? Multipolarity in currency use is not about overthrowing the dollar tomorrow. It's about ensuring resilience when the next shock hits. The irony is that this push doesn't require perfect coordination. Each nation acts out of its own interest. One diversifies reserves, another creates a digital payment rail, a third signs a trade deal in its local currency. Individually, none of these actions looks threatening. Collectively, they form a pattern, a gradual shift away from dependency, and once enough of the world is comfortable operating outside of the dollar's shadow, the network effect that has protected the dollar for so long weakens. For investors, businesses, and policymakers, the implications are profound. A world less dependent on the dollar is a world where U.S. borrowing costs rise because demand for treasuries isn't limitless anymore. It's a world where currency risk in global trade becomes more complex because invoicing is spread across baskets of currencies rather than one. It's a world where financial sanctions lose some of their sting because parallel systems exist to cushion the blow. And here's the critical point. Momentum matters more than perfection. No single currency, whether it's the euro, the yuan, or a new digital standard, is ready to take the dollar's full place tomorrow, but the movement away doesn't need a perfect replacement. It only needs alternatives that are good enough. Once those alternatives exist, the psychological monopoly of the dollar breaks, and when belief breaks, behavior changes fast. What's unfolding is not just an economic trend, it's a strategic recalibration of global power. For years, the dollar has given the U.S. an extraordinary privilege, the ability to print what the world demanded, to run deficits others financed, to exert influence far beyond its borders. That privilege is now being questioned in capitals from Beijing to Riyadh to Brasilia. And when privilege is questioned widely enough, it begins to erode. The lesson is clear. The world is no longer content to have one pillar holding up the entire system. The push for alternatives is not a passing headline, it's a structural shift. And when structural shifts begin, they rarely reverse. The dollar may remain strong for years, but strength is not the same as invulnerability. What we're witnessing is the early stage of a new chapter where dominance gives way to competition. And in that chapter, those who understand the shift early will be the ones who adapt, protect their wealth, and seize opportunities. Those who ignore it, who assume the dollar's role is unshakable, may find themselves blindsided when the very foundation they trusted begins to move beneath their feet. For decades, the dollar has been more than just money. It has been leverage, influence, and a silent form of power. Nations didn't just trade in dollars, they depended on them. Reserves were stored in dollars, commodities priced in dollars, debts issued in dollars. That central role gave the United States an extraordinary advantage, but in recent years, that advantage has been deployed as a tool of pressure, freezing assets, cutting countries off from the global banking system, using financial networks as extensions of foreign policy. These moves are reshaping how the rest of the world sees the dollar. What once looked like a neutral foundation now looks like a weapon. And when people feel exposed to a weapon, they eventually seek protection. The turning point was the use of sanctions on a scale the world had not seen before. In response to geopolitical conflicts, entire nations were shut out of dollar clearing systems, their reserves immobilized, their access to international markets severed almost overnight. The message was clear: holding dollars is not unconditional. If your politics collide with Washington, the very lifeline of your economy can be switched off. That message has resonated deeply across capitals worldwide, not just with adversaries, but also with neutral nations who suddenly realized their vulnerability. Imagine being a government holding hundreds of billions in U.S. treasuries, assuming those reserves are untouchable, only to watch another country's reserves frozen by political decree. That scenario forces a new kind of calculation. It is no longer just about returns or liquidity. It is about safety from political risk. And once that question enters the conversation, the dollar's role as the safe asset of the world starts to look less absolute. The global financial system has always been portrayed as rules-based, predictable, and universal, but when access depends on alignment with a single country's policies, others begin to question whether those rules are truly global or just conditional. And when trust in the neutrality of the system erodes, alternatives suddenly become attractive. That is why countries are investing in new payment networks, developing regional clearinghouses, and testing digital currencies. They are not doing this because it's convenient. They are doing it because they don't want to be trapped in a system that can be turned against them. The ripple effects of weaponization go further than sanctions. Investors also begin to rethink exposure. If sovereign assets can be frozen, what does that mean for private capital? If access to SWIFT can be denied, what does that mean for cross-border businesses? These are not hypothetical concerns. They are boardroom-level questions shaping decisions about where to invest, how to trade, and in what currency to operate. Each decision made out of caution chips away at the dollar's dominance, not in a dramatic collapse, but in a slow rebalancing of confidence. The irony is that the very strength of the dollar makes it an effective tool of pressure, but that same use accelerates the search for alternatives. When power is overused, it breeds resistance. History proves this. Empires that leveraged their currencies too aggressively always triggered countermeasures. The British pound lost its global role not only because of war and debt, but because other nations sought independence from a system that could be manipulated in London's favor. The parallels today are hard to ignore. Geopolitical competition is amplifying the urgency. Rival powers see an opportunity. If the dollar can be turned into a tool of coercion, then reducing reliance on it becomes a strategic necessity. This is why we're seeing coordinated efforts among nations to settle trade outside the dollar. Energy contracts priced in local currencies, reserves diversified into gold and alternative assets, regional alliances discussing shared payment systems. These are defensive strategies, but together they form the architecture of a new, less dollar-centric world. The real risk for the United States is not immediate replacement, but gradual insulation. If enough countries build workarounds, the effectiveness of sanctions declines. If trade can be conducted outside the dollar, the power to pressure through financial exclusion weakens. And if reserves are diversified broadly enough, freezing dollar assets becomes less of a threat. The more the dollar is used as a weapon, the less indispensable it becomes over time. For businesses and investors, this shift carries consequences. Global markets thrive on predictability. If the dollar is no longer seen as politically neutral, volatility increases, currency risk rises, new trade routes bypass traditional channels. The financial world becomes more fragmented, and opportunities come with greater complexity. Those who anticipate these changes will adapt. Those who ignore them will find themselves caught off guard when old assumptions no longer hold. The danger in dismissing this trend is that it underestimates human behavior. No nation wants to feel vulnerable. No leader wants to explain to their people why reserves vanished or why trade collapsed overnight due to sanctions. That fear is enough to drive innovation, investment, and collaboration on alternatives. Fear of exposure is one of the most powerful motivators in geopolitics, and today, that fear is fueling the quiet construction of parallel systems. The dollar is still strong, still dominant, and still central to the global economy. But dominance is not the same as permanence. Trust is the foundation of every currency's power. When that trust is shaken by the perception of political risk, it sets in motion forces that can redefine the landscape. The weaponization of the dollar may achieve short-term goals, but it also plants the seeds of long-term decline. The world is recalibrating. The more the dollar is seen as a tool of control, the more energy and capital will flow toward building independence from it. That doesn't mean the dollar disappears tomorrow. It means its position is less secure than it once was, and its future is no longer guaranteed by default. The ultimate question is not whether the dollar can remain dominant. It is whether it can remain trusted. And once that trust is compromised, even the strongest currency can find its power slipping away faster than anyone expects. The financial order of the world is shifting, and it's happening in ways that most people don't notice until the results are undeniable. For decades, global flows of capital, trade, and reserves have been structured around the U.S. dollar. It was the common language of commerce, the safe harbor for reserves, and the default for international contracts. But those patterns are starting to change, slowly at first, quietly, almost invisibly. And then suddenly, when momentum gathers, the shift becomes impossible to ignore. That's where we are heading now. Capital flows used to favor the United States almost automatically. When foreign governments or private investors needed a place to park money, they bought U.S. treasuries. They were liquid, safe, and dollar-denominated, which made sense in a dollar-driven system. But mounting debt, rising interest costs, and persistent deficits are altering that calculus. Investors are asking harder questions. Is it sustainable? Will returns keep up with risk? Can the U.S. continue to offer the same level of safety when its fiscal path looks increasingly unstable? The fact that these questions are even being asked marks a turning point. Trust, once unquestioned, is now conditional. Trade invoicing is also undergoing a structural shift. For decades, commodities like oil, gas, and metals were priced almost exclusively in dollars. That gave the U.S. a stranglehold on global commerce. Every nation needed dollars, whether they liked it or not. But deals are emerging that bypass the dollar. Energy trades in yuan, regional agreements using local currencies, cross-border contracts priced in euros or rupees. These are not symbolic gestures. They represent an intentional move away from dependence. Once a critical mass of trade is conducted outside the dollar, demand for it falls, and the network effect that sustained its dominance begins to unwind. Reserve holdings tell the same story. Central banks are diversifying. The dollar still holds the largest share, but that share is steadily shrinking. At the same time, gold purchases have surged to levels not seen in decades. Nations are signaling that they don't want all their eggs in one basket. Reserves are supposed to be the ultimate insurance policy, and more countries are deciding that an overexposure to dollars is a liability, not a strength. The diversification trend is not dramatic in any single year, but the direction is unmistakable. Over time, it changes the balance of global finance. Behind these shifts lies a deeper truth. No system remains static. The dominance of the dollar was never guaranteed by nature. It was built on confidence, liquidity, and the absence of viable alternatives. Now, those conditions are changing. Alternatives are emerging. Digital currencies are testing new settlement systems. Regional trade blocs are experimenting with clearinghouses that bypass the dollar. Financial technologies are creating the possibility of direct, real-time transactions in multiple currencies without routing through New York or London. Each of these innovations chips away at the need for a single, universal medium. Structural changes like this don't announce themselves in headlines. They build slowly, almost invisibly, and then they reveal their power in moments of stress. Think of it as dry tinder accumulating in a forest. Nothing seems urgent until a spark hits. When the next global crisis comes, whether economic, geopolitical, or financial, the world will lean on the systems it has been quietly building. And in that moment, the dollar's centrality could weaken faster than anyone thought possible. This is not speculation. Look at the data. 20 years ago, the dollar accounted for well over two-thirds of global reserves. Today, that share is below 60% and trending downward. Look at trade flows. China now settles a growing share of its commerce in yuan, and Europe has pushed for invoicing in euros. Even commodity exporters, long considered the most loyal to dollar pricing, are signing agreements to transact differently. These are not anomalies, they are signals. What does this mean for the future? For one, it means higher costs for the United States. If fewer reserves are held in dollars, if less trade is invoiced in dollars, if fewer investors automatically buy U.S. Treasuries, then the easy financing the U.S. has enjoyed for decades begins to dry up. Borrowing becomes more expensive. Deficits become harder to sustain. The privilege of issuing the world's currency is not a permanent gift. It is a function of demand. Reduce demand and the privilege fades. For the rest of the world, the shift means more complexity, but also more autonomy. Companies and governments will need to manage exposure to multiple currencies. Hedging costs may rise, but at the same time, nations gain flexibility. They are no longer forced to align with one system, one currency, one issuer of debt. Multipolarity in finance is messier, but it is also more resilient. The biggest mistake would be to think these changes don't matter until the dollar loses dominance. That binary thinking misses the point. Dominance erodes in degrees. A drop from 70% to 55% in reserve share changes the balance of power. A shift of major energy contracts into non-dollar currencies changes global demand dynamics. A redirection of capital flows into alternative markets changes where influence lies. These aren't small adjustments, they are foundational. The world doesn't need a perfect replacement for the dollar to move away from it. It only needs workable alternatives. Once enough participants see those alternatives as good enough, the old system weakens. That is exactly what we are witnessing now. The structural shifts in financial flows, trade, and reserves are not speculation. They are happening in real time. The lesson is clear. The financial world is realigning. The habits of the past automatic trust in U.S. Treasuries, automatic pricing in dollars, automatic reserve dominance are breaking. The future will not be defined by one pillar, but by many. And when the dust settles, the dollar will still be important, but it will no longer be the unquestioned center of everything. Those who understand this shift early will adjust, diversify, and thrive. Those who cling to the old order will be caught by surprise when the new one emerges fully formed. The biggest misconception about the dollar's position is the belief that because there is no immediate, perfect replacement, its dominance is automatically safe. That kind of thinking is dangerous. It assumes history moves slowly, that inertia will keep the system intact, and that the absence of a single challenger means the status quo is untouchable. But reality doesn't work that way. Systems don't need a perfect substitute to unravel. They just need alternatives that are good enough, combined with a loss of confidence. Once confidence breaks, even inertia can't hold the center together. Look at how most analysts talk about the dollar. They argue that no other currency matches its liquidity, no other bond market rivals U.S. Treasuries in depth, no other system offers the same global reach. On paper, they're right. The euro is constrained by fragmented fiscal policy. The yuan is limited by capital controls. Digital currencies are still in early stages. So yes, nothing today can fully step into the dollar's shoes. But that argument misses the bigger truth. Dominance doesn't end when a replacement is ready. It ends when enough people decide they no longer want to rely on the incumbent. That decision doesn't require perfection. It requires dissatisfaction and alternatives that reduce exposure. History proves this point. The British pound didn't lose its place as the world's reserve currency because there was a flawless substitute waiting in the wings. It lost its place because Britain's economic and political foundation weakened, while the U.S. offered a relatively stronger option. It was messy, gradual, and uneven. There were years when the pound and the dollar coexisted as global reserves, but once trust shifted, momentum carried the process forward faster than anyone predicted. The same dynamic can apply today. The dollar doesn't need to collapse, and no rival needs to dominate on day one. What matters is the trajectory, not the snapshot. The speed of change is often underestimated. People think in decades, but trust can erode in months. All it takes is a shock, a debt crisis, a geopolitical conflict, a sudden inflation surge, to push nations and investors toward the alternatives they've been quietly building. Consider how central banks have been diversifying reserves. For years, the shift was measured in small percentages, hardly noticeable. But when you zoom out, the trend is clear. The dollar's share of global reserves is shrinking, while gold, yuan, and other assets gain. Once momentum hits a tipping point, the flow can accelerate dramatically. The same applies to trade invoicing. It doesn't need to flip overnight for the dollar to lose ground. If even 20 or 30% of global trade begins to be conducted in other currencies, that's enough to weaken demand for dollars. The network effect, the cycle where everyone uses dollars because everyone else does, starts to break down. Once that cycle is broken, behavior changes faster than anyone expects. Because at the end of the day, people and nations adapt quickly when they see their peers moving in a new direction. Inertia is powerful, but it is not invincible. Think about technology. Kodak thought inertia would keep film dominant. Nokia thought inertia would keep them on top of mobile phones. Blockbuster thought inertia would keep customers coming to their stores. In each case, there was no single competitor that seemed capable of replacing them immediately. But once alternatives reached a certain threshold, the collapse was swift. The same logic applies to currencies. Dominance is fragile when it relies on complacency. Another misconception is that because no one wants the responsibility of being the global reserve issuer, the dollar is safe by default. But that ignores the reality that nations don't need one reserve. They can use many. Multipolarity is not about crowning a single new king, it's about building a system where no one king rules. That's already happening. Central banks are holding more diversified baskets. Regional payment systems are reducing dependence on U.S. financial infrastructure. Bilateral trade deals are denominated in local currencies. All of these together create a web of alternatives that weaken the dollar's monopoly without replacing it outright. The U.S. still has advantages: depth of its financial markets, legal protections, global reach. But those advantages don't immunize it from decline. If debt continues to climb, if political dysfunction deepens, if inflation erodes stability, confidence will falter. And once confidence falters, alternatives that seemed second best suddenly look acceptable. Investors and nations don't need perfect, they need something safer than what they perceive the dollar to be. The danger is complacency, believing that dominance is unshakable because inertia protects it is exactly what leads to being blindsided. Every empire, every currency, every institution that thought it was immune learned the same lesson. The world adapts faster than the incumbent expects. The pound, once the unquestioned global reserve, is the best example. Its decline wasn't planned, but it became inevitable once the underlying foundation cracked. For the U.S., this means one thing: the absence of an immediate replacement is not a guarantee of safety. It is a window of time, a fragile window, that can be used to correct vulnerabilities or squandered in complacency. The rest of the world isn't waiting. They are building alternatives now. They are diversifying now. They are testing systems now, and when the moment comes, they will not hesitate to move. So the question is not whether the dollar has a challenger ready today. The real question is how fast confidence can erode once people stop believing the dollar is untouchable. Because dominance does not disappear in theory, it disappears in practice when the world votes with its reserves, its trade contracts, and its capital flows. That vote is already shifting. And if history is any guide, once the shift reaches a tipping point, inertia won't be enough to hold the dollar in place. So what does this mean for you, for me, for everyone in this room or watching online? Because let me tell you, in a world where USD dominance begins to erode quickly, there are both perils and spectacular opportunities. If you're positioned right, if your business, your investment strategy, your country's policy takes account of these shifts, you can ride the wave rather than get crushed by it. Diversify your exposure. Understand which currencies are rising. Track geopolitical risk. Explore alternative payment channels. Prepare now. But if you do nothing, you assume it can't happen fast. You might be the one scrambling while others are already adapting. The era is changing. The balance of power in global finance is shifting. Let me leave you with this. Dominance isn't a birthright. It's maintained by confidence, by trust, by systems. And when those break, change comes fast. So ask yourself, when the world changes, will you be part of shaping it or left reacting to it? Because the U.S. dollar has been king for a long time. But today, the throne is wobbling. And the question is not if the fall accelerates. It's who will adapt fastest when it does. Thank you.